So next is to establish the type of hedge. So are you clear about this relationship? So three conditions has to be fulfilled, that there must be an economic relationship, credit risk should not dominate, and you need to maintain the same hedge ratio. How much you are going to import, that much worth of contracts you need to enter. There are three types of hedge called a fair value hedge, which will hedge exposure for the change in the market price. Cash flow hedge, which will just look into the cash flows, not the market price. And investment of operation, that means your entire investments is going to look at as a single asset. So in India's 21, we are going to talk about it, about the foreign currency translation reserve, so that we convert that into INR that way. The last one is the hedge accounting. So among this hedge accounting, the fair value hedge is fairly simple, but cash flow hedge is little tricky. So again, at this point of time, I have done in the past R&D, so many examples, but ultimately it is not much relevant right now. Going forward, if any such questions come, I will put up in the YouTube and all. You can see the detailed explanation. If it is the fair value hedge, the gain, there can be a gain or there can be a loss on the hedged item. Like you thought 50 lakhs, the fees, the school fees 10 years down the line can be 40 or can be 60. If it is 40, it's a gain for you. If it is 60, it's a loss for you. Now adjust the carrying amount of the item and recognize the gain or loss in the P&L account, whatever it is, because the hedged item is, say for example, it is an asset. If it is a loss, you pass P&L account debit to asset, gain asset account debit to P&L, or whatever, liability, whatever. One leg should be on the as item, another leg should be the P&L. Since you are performing hedge accounting, there is one against this item, there is one derivative instrument also. And if you make a gain here in that derivative instrument because of the economic relationship, all this hedge ratio and all, you have made exact loss there. If you have in the item, if you have made a loss, you have made exact gain there. So recognize the derivative gain in asset liability and credit to the P&L or OCI. So one leg you bring here, another leg you bring here. So both will offset and net is 0. Are you clear? And this derivative assets you are going to offset. After the asset is closed, you transfer this to that particular asset or whatever it is. So because of this hedge accounting, did you see the impact on P&L is maintained? You didn't move it, it is not variable now. It will go to the balance sheet. Differences will, derivative asset or liability will go to the balance sheet finally. Now there comes the cash flow, which is a little tricky. It says that the cash flow hedge reserve will be created. In your OCI, you will find this cash flow hedge reserve, which is not your, what is that called, recyclable. Now cash flow hedge reserve will be created, which is the lower of effective hedge, which is cumulative gain or loss on the hedging instrument. That means you need to find out on a cumulative basis how much gain or loss you made versus cumulative change in the fair value. Because see, we have got an inverse relationship. If you try to figure out the cash flow is hedged. But what goes for a toss? Fair value will go for a toss. So what they are trying to tell, look, because of the cash flow hedge, you compare lower of fair value of the changes, cumulative change in the fair value versus cumulative gain or loss in the hedging instrument. Actually, this cumulative change in the fair value is not accounted in your books. It is off calculation. So whichever is low is considered to be an effective hedge. Followed, no? At this point of time, let us not go more deeper. I can give an example explaining, but too much confusing. So the remaining portion, after, if the out of, say, whatever cash flow hedge reserve you have created, 100, out of that 60 you said it is effective. Effective will go to OCI. You have made a, see, under cash flow hedge what happened, no? There is no balance sheet, there is no P&L. You hedge your only cash flows. And you have got a derivative instrument also. So derivative instrument will have a gain or loss. Say for example, derivative instrument has got a gain. What you must have lost? Fair value you must have lost. So how much your gain has supported your fair value? That much is called effective hedge. Say for example, out of 100 gain you have made, 60 will transfer to OCI. And the balance 40 you will take it to the P&L account. Because up to 60 you can't say that, oh, it is my profit. Why? Because that much loss your company has incurred in the form of a reduction in the market price. In the process to protect the cash flow, your market price has gone down. So how much? That's a separate calculation, and that much you hedge it. So this is your ineffective P&L. So ideally it should have been 0. So the moment somebody sees ineffective portion, and they understand, okay, your hedging is not perfect. Whatever, the amount of the cash flow hedge reserve will be reclassified to P&L account. Okay, this is a subject matter of reclassification. Equity FVOCI, debt FVOCI, and there is one cash flow hedge reserve also. On the day your fully account is closed, hedging is complete, you will transfer it to the cumulative balance to the P&L account, in which the hedged expected items are going to come to your P&L account. Anyhow, based on this, there is one question which is there in the MTP. So we are not going to talk that, because again they are not included in your study material. You can practice it later based on the, like I will share the solution. You can go in similar fashion, they have discussed it. Foreign operation, foreign currency translation reserve will be created for the effective portion. The remaining portion will go to P&L account, same like cash flow hedge. Now, okay, so I have given some information, para 6.5.4 a hedge. In fact, this information I have given you so that study material MTP question, no, you can understand it proper, because there is some vagueness in that MTP question. So again, not required. Don't bother about this at this point of time. When you solve the study material, MTP question, if you want, you can check this, but it is not a priority. So summary will be fair value hedge, item is there, instrument is there. Hedged item is an equity. Equity is FVOCI, if at all you are done. Gain also you will take to FVOCI. If equity FV is not an FVOCI or debt is not an FVOCI, then you take both to the P&L account. In cash flow hedge, effective portion you will take to the OCI, ineffective portion you will take to the P&L account. Hedge in foreign operation depends upon effective portion or ineffective portion. Okay. Yeah, let us see the solution, theoretical question. In fact, there is no theory questions also in this, but there is one question, explain hedge accounting. So what you need to write, that we will see. Yes. So now we will start with the theoretical questions which are highly probable in the exam. You remember up to definition we have discussed. Then classification I kept pending. I said, okay, let us solve the problem, because otherwise it becomes pure theoretical. So there are few questions here which are highly probably exam oriented. So I just want to discuss. You have to read it yourself, practice it yourself, because these are theoretical. But I want a discussion here. Simply, I don't want to read this question. H Limited makes the sale of goods to the customer with the 60 days credit. Customer is entitled to earn a discount of 5% if the payments are made before 60 days. Interest of 12% is charged, payment after 60 days. Now, the company does not have a policy of selling its debtors, and we didn't discuss it, no? Classification have we completed? Yeah, on day one we have done. That's what. Again, I didn't discuss much theory, because without solving problem, if I talk about classification and all, it will be too much at that time. Okay, now you see how it is easier. Now, how do you evaluate this financial instrument? Tell me, students. If this question is asked to you, what you are going to write? What is this? This is a financial asset. Why? You have got a contractual right to receive the cash. How do you classify this? Huh? So amortized cost. Okay. So you say that in the B1 course there is a contractual right because it is a financial asset. Now business model is to satisfy, to hold, because we said we don't sell the debtors. That we told here, no? We don't have any practice of selling the debtor. That means we are going to hold them. And is this debtor is going to pass the SPPI? Yes. Because there is nothing that they will give you extra more than that interest or whatever. So it is classified at amortized cost. Simple answer. Very low probability, but it may ask. Okay, this question can be a probable question. Container Limited provides the containers for use by the customer for multiple purpose. Big containers, no? The containers are returnable after 3 years. In addition to the monthly charge, they will charge you monthly. You need to keep one security deposit with the containers limited, 10,000 rupees per container. And this refund is given to you when after 3 years, when the service is going to terminate. Deposits, you will not get any interest. That means today you have to give one deposit to me. I will give you one container to you. That container you can use it for any purpose. And you have to pay me monthly rent on that container. But I want one container deposit. 10,000 you have to deposit with me. And the day you return that cylinder or container back, I will give you a container deposit back to you. Now analyze the fair value upon initial recognition in the books of customers leasing containers. And also pass the initial interest. Market rate of interest on the similar loan is 7% per annum. Now what is that you are going to do here? What is the question? What did you understood with the question? What is that? Analyze the fair value means what? What you are going to write? Huh? No, yeah, that calculations you are going to do. No. What do you mean by analyze now? Analyze means look into the very detailed way. Now, what is your fair value now? Huh? Transaction cost is the fair value. Why? 7%. You will say it's an off-market instrument. That's why it is not the transaction price I cannot consider. So, what is my transaction cost? What is my fair value? Present value of the future cash flows. Probably you may make one working. Then pass the journal entry. Anyhow, we have done this type of questions. Clear? So, we will say that look, it is a financial asset for you because you have got a right to receive the cash. Look, understand, they asked in the books of the customers, not in the books of that leasing container. For them, what it is? Financial liability. So, in the examination, same question may come and the customer, no, they can say in the books of containers limited. Same story. And I showed you also one examination question. How they asked you as a same question for another party, that subsidiary and parent. So it's a financial asset. It should be recognized at a fair value, subsequently at the amortized cost, because your objective is to hold to collect. It is an off market, thereby fair value will be computed. So your calculation will be 10,000 minus 8163, present value of the future cash flow, use the differential amount. Now how do you account this differential amount? You say that if the differential amount is because of the observable inputs L1, we recognize in the P&L account because the question is very silent. If it is unobservable, what we are going to do? We are going to recognize it as an asset. In the given case, since I don't know what it is, whether observable or not, so I will assume, since it is not available, I will assume it must be L2 and it meets the definition of an asset for me. Why? Because I get a right to use the container. Can you tell, sir, I will pay the rent, but I will not pay the deposit? No, you cannot tell that. So if you want to get the right, you have to pay that. That's why it's a prepaid rent. Alternatively, you can say ROU asset. Initial recognition will be security deposit account debit, ROU asset account debit, or prepaid rent account to bank. Problems we have solved it. No, point here is, see, this is the theoretical question. The word used here, verb is analysis. Look into the marks. Okay, your calculation will fetch you 1 mark here. Journal entry may fetch you 1 mark. What else you are going to write for 4 marks? So maybe probably this particular portion 1 mark. Explaining accounting is 2 marks. I don't know. This is the way you have to think. This can be the mark allocation. Next, the shareholders of company C provide C. Actually, C Limited is a company. It's a shareholders provide with the financing in the form of loan notes to enable the acquiring the investment in the subsidiary. Have you understood what they are trying to tell? Have you understood the first sentence? What happened? What is this? In plain layman language, tell me. Huh? Sorry? Who issued debenture to whom? To its shareholders, or not to the general public. Why? because with that money, they can acquire one new company. See the complex arrangement. If you want to acquire a new company, shareholders themselves could have gone and acquired. No. What did he understood? No, there is one shareholder here. Under him, there is a P limited. There is S limited. He himself could have invested here. No, he gave a loan to the parent, and parent went and acquired this subsidiary. Now the loan notes will be redeemed solely. Now how you will repay this loan? They say that the loan will be redeemed solely out of dividend received from these subsidiaries. When the subsidiary pay you dividend, use that to repay this loan. Objective is very clear, Baba. You wanted to hold that, acquire the subsidiary. You didn't want it to hold directly by investing. You routed it through one P. And the terms and conditions of the loan is such that you told me you pay me only if they declare you the dividend. And principal you pay me become redeemable only when the CA has got a sufficient fund to do it. If you don't have the fund, you need not refund me. Sufficient fund refer to the dividend receipt. That means over the period, if you get the dividend, then you pay me dividend and interest. Principal and the interest, otherwise not required. How do I measure this loan note? Yes, tell me, students, how do you measure this loan note? It's a financial liability. To whom? For whom the financial liability? See, do you have got a contractual obligation to pay cash? No, then can you avoid that cash? Yes, because I can always say no. Can you force that subsidiary to pay the dividend? No. You can't ask them no. Then what it is then? What is the entry you pass initially? It's an equity for you. It's an equity. Otherwise also it would have been an equity. You routed through somebody, but see, we understand and apply the test here. Okay? So the loan is in the shareholders, not applying under conditional right concept, not repayable on demand. Okay, the nature of the instrument, the answer will be written like this. What is the nature of the instrument? Loan is repayable only when C earns the dividend. So C cannot be forced to pay. That's why it is not on demand. First of all, this loan is not on demand. Like I will demand you pay me. I cannot force you unless the dividends are received. How do you measure? Initially measured at the fair value, which is expected future cash flows at the discounted market rate. The amount and timing of the expected future cash flows determined on the basis of expected. So if you can expect when they will pay the dividend, Baba, it is your own company, no. If you expect, based on that you can discount it. This is a different type of question, okay. Now, what about the differential amount? If in this process, when you find out the present value, if you get the difference between the amount of loan and the fair value, because the financing is provided by the shareholder in the capacity of the shareholder, it is reflected as an equity. You have to treat it as an equity. You don't take it a P&L account. It's considered as an equity contribution in the C's balance sheet. In the books of shareholders, it's an investment in C limited. The difference will be investment in C. Now, if you can't measure it, then the fair value is what you given only. Suppose if you have given, how much money is given here? 10 lakhs, say for example. If 10 lakhs is given, then you pass the entry, bank account debit to investment, bank account debit to loan. But that loan will be in the form of an equity. Because you cannot measure the fair value. If you measure it. Difference will be, but entire instrument will be an equity instrument. Nice question on the classification. See, now you can appreciate it better because that Q&A part you have done. So that way I am proceeding going forward. No, first I will focus on the questions. Investment, no, it's a financial asset for you. No, it's a financial asset. So when it comes to financial asset, whether it's a, what do you consider? For you, for the shareholders, it is an asset. No, so there is no such classification. Only for the receiver, there is a classification whether it is a liability or an equity. Silver Limited made an investment in OCPS, optionally convertible preference shares, of a Bronze Limited. Silver Limited is one entity. It has invested in the optional convertible bonds. So for Silver Limited, what it is? Financial asset. For Bronze Limited, we don't know. It may be a compound. Optionally convertible. Now question is very silent, in whose option? So many things are there. Of rupees 100, face value also 100 rupees. Now Silver Limited has got an option to, okay, now this option is with the Silver Limited. Yes, therefore them it is compound then, provided it passes fixed for fixed test. Equity in the ratio of 1:1. Chalo, fixed for fixed test also passed. And if such option is not exercised till 9 years, they are redeemed at the end of 10th year with the 20% premium. Now it is very clean. For silver, it's a financial asset, so split not required. But for bronze, it is a compound instrument. Okay, the option is meant for fixed test. And what is my financial liability? Both principal and interest. Because if you don't opt, I have to pay it. And it's a compulsory interest I have to pay. Analyze the measurement of the instrument in the books. In the books of whom? Silver. Now, all this compound story you don't give there. Because compound instrument is not applicable to silver here. It is applicable to bronze. Be clear in the examination whom they will ask. Same twist, silver, they may repeat silver and bronze also. So that you should feel very happy. Oh, it's a study material question. Twist comes at the end, and that is conceptual, it is not procedural. If they ask you same question, it is procedural. Follow? Yes, now what is your answer? Analyze the measurement. Be careful what they ask you, subsequent measurement, initial measurement. So, is the financial asset for you, should be at a fair value, subsequently at a classification of the instrument. The subsequent measurement upon the classification. Now tell me, what is the classification? What is the subsequent classification? For this, what you need to do? For financial asset subsequent classification, what you are going to do? Yes, Vidya. This is a financial asset. This is a financial asset. Initially, how do you measure it? Fair value. What is the fair value? Present value of the future cash flows. Simple. Now, you have to subsequently, how do you measure it? That depends upon the classification. There are 3 classifications for a financial asset: amortized cost, FVOCI, FVTPL. What you are going to classify? Amortized cost. They may convert also. So will it pass SPPI test? It doesn't pass. See, something doesn't pass an SPPI test, then HOC, hold for business model, doesn't not applicable only. Where it will land up? FVTPL. Is it an equity share? Or it is a preference share right now? See, something will go into FVTPL. But if it is an equity share and not held for trading, then you have got an option to take it to FVOCI. So, since it has failed SPPI test, where it will land up? FVTPL. Do you have any option from FVTPL to take to FVOCI? No, this option is there only for equity shares. Otherwise, a debt instrument which is held for HOC as well as sale, that will land up, but it is not an option. There are only 2 options. One, accounting mismatch you can take to FVTPL. Equity shares from FVTPL you can take to FVOCI. Other than that, there is no other exceptions or no other options. Followed, no? So what you are going to account it? FVTPL. So you have to write here, see, answer, I have given you how much you need in the examination. Huh? Don't, I study material and I have trimmed it nicely. How much you read it straight away enters your mind, copy and write. But practice it, you understand what you are writing. Business model test passes, but SPPI test it fails. Holder can realize the return by conversion also, no? That's why it is taken at FVTPL. So from periodically you have to measure and transfer this P&L to P&L. Clear? Okay, next question. A invested in the equity shares on 15th of March for 10,000 rupees. The transaction cost is 500 rupees. On 31st March, the fair value is 11,200 rupees. Market interest rate is 10% per annum for a 10-year loan. Now analyze the measurement principle and pass necessary journal entries. Yes. First of all, okay, wait. Who is investing where now? In whose books we have to pass the entry? Journal entry? Huh? A limited. Why? As you told me? Assumption. You said it must be an A limited entry only, because yeah, if you go to the solution, let us see in MTP, did they tell me anything? Company invested in another company, transaction cost, fair value, so and so, pass necessary as when a financial certificate. And they gave me clarity also, it is at FVTPL. In this question, equity clarity they didn't give me. So it is a subject matter. First question is a subject matter of an assumption. Second question is not a subject matter of an assumption. Okay, chalo. Now tell me, is it a financial asset? How do you recognize initially? At a fair value. Simple. What is fair value? Are Baba, SPPI subsequent. No, I am talking about the initial measurement. Because they said analyze the measurement principles. It includes initial and subsequent. No. Initial issue, at what value I will measure? Fair value. What is fair value? Transaction price generally, provided it is market term. Is it market terms or off market terms? Market terms. Are you investing in shares and telling one rate of loan? It is a confusing factor no here. Can you find out the present value of the future dividend there? So, interest loan of a bank is not comparable with the equity shares. So, it is at a market term. Now comes the transaction cost, which also you should decide on the day one only, not subsequently. What do you do with the transaction cost? Then for transaction cost of 500 rupees, what you are going? Why? See, if you say add, I am going to deduct, it's the procedural. Why? Answer me, it's conceptual. Now, then you should tell me, sir, for transaction cost accounting, we need to decide classification. On that classification, it depends. No, what is my classification of this equity? What you are going to do here? Option is always there. Have they opted for this? Question is silent. Now it is a subject matter of assumption. But if you look at the MTP question, they said no, this is accounted as FVTP. That means they have not opted. Students, are you getting connected? Getting connected? Yes. Okay. So now here the transaction cost will be debited to P&L. So you say that equity instrument is a financial asset to A limited, and you need to record at a fair value. What is the fair value? The transaction price, because you cannot compare, you equity and all, you nothing. And equity is going to fail SPPI. It is classified at FVTPL by default. There is one option, but the question is very silent about the option. No. So what we will assume? Not opted. If we don't opt, then we will classify it at FVTPL. Then transaction cost will go into P&L account. Clear? Yes, again, please go and practice this theory question. See, I have given select questions. There are still, see, if you look my additional questions, no, there are big additional questions. It's not your priority right now. These questions thoroughly you study, understand why we are doing. I'm telling you, you are done with your accounts preparation. Like this, we will focus on big things. 103 we will focus now, 116, because those places we will spend maximum time. Then small chillu munnu, chillu pillu standards are going to come. You will ask me, sir, have you finished accounts? This looks heavy, student, I understand. But no option, no. We have to cross through this. And I am telling you, more you practice, it will become like a monkey. It will play the way you tell it. But only your determination, you have to sit up, practice, that is needed. You understood the way now, and you have to walk. Okay? So now, what is my journal entry on initial day? Tell me the journal entry. Investment, debit, cost also debit to bank. So you will pass this entry, investment account debit, transaction cost account to bank. And what will do with the transaction cost? you transfer to the P&L account, because this is predominantly journal entry based question. Was a part of one big question, I would have written only first country, and maybe probably I would have written in bracket P&L. But predominantly it's the journal entry based. Subsequently, there is a fair value increase now. How much it became? 11,200. So it's a gain. So investment in equity account debit to fair value gain. Where do you take? P&L. Then you transfer this fair value gain to the profit and loss account, because your classification is FVTPL. How much? 1,200. The difference between this minus 11,200. Yes, clear? Yes, Vishnu, getting, no? See, again, go through whatever, you may have some minor and not misunderstanding, some gap here and there. You may not be able to process it fast right now at this point of time. But for that answer is only the practice. You go practice it repeatedly, just it will sit in your mind. Now, next question you should tell me. Metallics made an investment in the equity instrument of a company called a Castor Limited. How much? Some 19% stake. Be careful. Since it is 19% stake, no significant influence. If it is more than 19% stake, then significant influence come, then India's 27 gets attracted. It is 20% onwards. But need not be, but generally 20%. Now, the moment 27 comes, no, 27 will give an option, either 109 or cost. 109 or cost. This will come only if you have got a significant influence. If 27 is attracted, right now, since they made our life easier, 27 is not attracted. 19% equity stake, significant influence not exercised. We understand why they have to tell me. Investment was made for 5,10,000 equity shares. On 30th June, the fair value is 45. Company has taken an option to maturate at POC. They didn't tell what they are expecting. Probably they must be asking journal entries. Can you please pause the video, students? Please pause the video, take out your rough book, pass the journal entries for this. Okay, students, so we'll check. See, in examination, I can give you more variations of this question. Okay, what if transaction cost comes? What? Those are all conceptual. So your top priority, first distinguish which is procedural, which is conceptual. In the exam, first focus on the procedural. Do all the procedural thing. Then, okay, full time. Definitely some 40 marks to procedure will be there as per my understanding. Then you enjoy. Nicely you do all additional thing, apply what you learn. Okay, so we'll compare the answer. First thing, okay, theory is required because the question is very silent about the verb here. So the theory will be it's a financial asset. It will be recorded at a fair value. Subsequently FVTPL, but since there is a option and which has been exercised, it will be taken to FVOCA. So my initial recognition entry will be investment to bank 5 lakh at 50 rupees per share. Subsequently, I incur the loss. So fair value loss to investment. And what I will do with the fair value loss? I will transfer to OCA. So 3 entries are required. Why? Because this is predominantly your journal entry based. So if you are just passed here and written in a bracket, it's a risk. We may not get one of the marks. So you have to be careful. Followed, no? Now let us see one examination question. Okay, pay attention. Now, this question has come in the examination, but the way it didn't came as so simple. There is some twist. Now, XYZ Limited is a company incorporated in India and provides 10 lakh rupees interest-free loan to its wholly owned subsidiary ABC. This is same story like that parent has given one preference share. You have to repay after 3 years. We have seen, no, 0.001% inter dividend, something like that. And there are no transaction costs. Nice. How should the loan be accounted? As per Ind AS in the books of XYZ, ABC and consolidated financial statements. An 8-mark question in the exam, predominantly theory. If the loan is repayable on demand, the terms and conditions says that parent has given a loan to its subsidiary and say, whenever I ask, you have to give it back to me. In that case, can you find out the present value of the future cash flows? No, because you don't know when they are going to. So always the fair value will be transaction price only. Second, loan is payable after 3 years. Specifically, there is no intermediate interest. 10% loan. Now we know that is the same thing. We will discount the present value of the future cash flow 10 lakh, and we split that and we will keep it as an investment in subsidiary, contribution, capital contribution, interest income, all the story. We know that. Loan is repayable when ABC has funds to repay the loan. So in that case, it cannot be treated as financial liability, because you have, okay, we'll see what is that. If such cases, what we need to do? It's something very similar to that loan that shareholders gave to their company and to invest in another company. So there is one theory that you have to go into the substance, look what type of loan, can you predict how much money. In that case, what we told? We have to see that, find out the fair value by predicting when that subsidiary is going to give the dividend. Like this, in this case, we have to predict when the subsidiary may give that money back to me. Based on that, I have to find out the fair value. Else you pass the entry for 10 lakhs. In the examination, this question came as it is. But when they asked you, they mixed one thing with the RTP question. This question came in RTP, MTP also. See, understand, the answer pattern of the study material and RTP, MTP contents are same, but the way they answered is different. The format of answering. So this creates a confusion for the students. Then they asked in the examination. If you look at this question, this was already sitting in the study material. This came in your May 19 RTP, October 20 MTP, but with the different format of answer. I have given similar format so that you will be able to appreciate it. If you want more confusion, please open the RTP and see how they have answered it. And then it came in the December 21 exam. Okay. Now what extra happened here? They said repayable on demand, 3 after, they have funds to repay. Briefly analyze the above scenario. That means I need to give theory. Study material, where is the theory? How should the loan be accounted? Analyze word is not given. Then also pass the journal entries in the books of Ram and Balram. Have they told you here journal entry? No. Study material solution, they have passed the journal entry. Then the present value of the value factor they have given. This is for the second scenario. Followed, no? So what is your answer? Okay, I'll discuss this. So the first case, as per Ind AS 109, the financial liability shall be recorded at a fair value after adjusting the transaction cost. Transaction cost is not applicable, and 113 says, now we will go to 113, which you are yet to do. They said that if there is a liability with the demand feature, it shall be discounted from the first date that could be required to be paid. 113 says that if there is anything demand, you discount it from the day when you are planned to get. But demand, there is nothing, no, we cannot plan. That's why, considering this, we will consider all this scenario. Scenario 1, repayable on demand. Since the loan is repayable on demand, no time limits are given, its fair value is always equal to the cash consideration. So the parent will recognize as a financial asset, subsidiary will recognize as a financial liability, no interest accrual, no amortization schedule. Repayment, they will reverse the entry. So first day, loan to ABC, a loan to bank, bank account debit to loan to ABC. In the books of the subsidiary, bank to loan from XYZ, on repayment, loan to XYZ to bank, simple. So whenever any loan comes with the demand feature, this is what you need to do. That means present value of the future cash flows are not possible. And this is the same thing applicable to that loan notes, which the parent gave to the C gave to the investment. Now if it is repayable after 3 years, then everything is same, but you should measure the fair value by discounting, and the difference will be investment and equity contribution. I can proceed further. We have done that, no, parent has invested in preference shares and all. So the transaction price is 75 lakhs, present value factor is given, we find that this is the difference. Then we prepare an amortization schedule, we take this opening fair value, opening book value, prepare an amortization schedule, get 10 lakhs. Then we pass all the journal entry, like first initial recognition entry, year end interest, interest, interest and repayment. Similar entry, see 8 mark, how many entries we need to spend time, but no choice with the narration. But here interest income in bracket only, write P&L. Apply your judgment. Now initial recognition ulta entry I'll pass, year end finance cost, finance cost, finance cost and payment. Now scenario 3, loan is repayable when the funds are available. Then the standard says, then you need to estimate the repayment date. If you think that it's paid in 3 years, then do it as per scenario 2, 1 mark. In consolidation, what's going to happen? If you see, both are opposite. See, this entry is the opposite of this entry. Both will get eliminated. Eliminated. Consolidation. At that time, we will learn. See, there we say that both the interest income and expense, debtors and creditors will get eliminated. So this entry has got no impact, or because my cash from this pocket, it went to this pocket. No change, because parent's money is with the subsidiary. So consolidation, it will appear as a group. We will get a more understanding as we proceed further. Now this question they gave in RTP, everything same story, okay, 10 lakh, loan on demand, repayable, everything same, except one extra addition happened. Further, company is also planning to grant interest from loan from YK to KK. What if the subsidiary will give loan to parent? What will be the accounting treatment? This is one extra in the RTP. In that examination and all, they didn't ask you. Maybe in your attempt, they may ask you with this one mark question. So based on the answer is suggest the accounting treatment, consider interest only for 1 year. See, the journal entry you should give only for 1 year. Don't give like that previous full. See, they gave you 2 different things, students. Understand? In the study material, they didn't ask you journal entry only. They give for full year. In RTP, they asked you journal entry only for 1 year. In examination, they asked you a question for which you have to provide full. They make you confused. Look into the question. So again, I'll proceed further. So you will write the same story. Sorry? 1 year, but they have given, no, if it is there, they have given you the fair value also. In the study material, we had to calculate this. In this RTP, they gave you interest with the fair value. So the calculation doesn't carry you any mark there, if they give you. Straight away you start with an amortization schedule also not required. Study material we prepared an amortization schedule. Why? I have to provide entries for all the years. In this case, I don't require an amortization schedule. Why? They asked me interest entry only for the first year. So in the narration only I will do the calculation. So first it is the same entry, loan to bank, bank to loan, loan to bank, bank to loan. Now if it is a repayable after 3 years, then it is a difference will be investment and equity, same theory I will write. But I am not going to do any working because they gave me the output, fair value, and the amortization schedule not required because they asked me interest entry only for first year. So I will pass the initial entry and only year end entry. But when I pass year end entry this time, interest income I will transfer to P&L. Issue doesn't tell all this thing, but they will deduct marks. They expect you observe it and understand it. Because life is also like that. No, audit is also like that. Management will not come and tell you everything. They have hidden it somewhere. So you should get that skills to observe and make a guess. Oh, this must I should be doing. Then you will be able to find the frauds done by the management. So on repayment, bank so and so, okay, same repeat entry is going to happen in the subsidiary. Loan is repayable when the funds are available. You will decide what to do. If they are payable, then scenario 2. What about the consolidation? It should be eliminated. No effect. Now, what if the YK is planning to give loan to KK? In that case, the difference what you get, no? It is treated as a dividend expense and dividend income. See, if the parent gives the loan to the subsidiary, for whom it is benefit? Interest-free loan. If the parent gives interest-free loan to the subsidiary, benefit is for whom? Parent or subsidiary? Subsidiary. So in the parent's book, it is the investment. For subsidiary, it is a capital contribution. If the subsidiary gives interest-free loan to the parent, it is the dividend what I have got For my investment is made in you. So the damn difference if the subsidiary asks to parent, no, this is what that they have asked in one of the exam. I told you, no, they shifted. It is treated as a dividend income for the parent, dividend expense for the subsidiary, the differential element. It is no more investment and capital contribution. Capital contribution and investment, if it goes like this, it is a dividend return. Follow, no, parent can give you may give direct money to the parent, taxable. No, you will give a loan, interest-free loan to the parent. And you tell the parent, okay, go and keep it in some FD and all, you earn interest on that. All our accounting standard has seen this.